So we learn about the fundamentals of accounting. Fundamental of accounting is based on the accounting equation: assets equals liabilities plus equity. Now, this should always hold true. As we move on, we're going to see how this plays out again and again in every single chapter we study. Assets always has to equal liabilities plus equity. You're in business because you want to build your assets. Your assets is what you want to build. And you can do that through two ways. You can borrow money, or you can have equity investment, or use your profits to reinvest into your business to build more assets. The bigger your assets, the more your revenue you can generate. So if you're very efficient in your business, you should generate enough equity that keeps adding to your assets. That's the best way to grow, is through equity, like especially through retained earnings, because in that way, you're not dependent on other people like loans or, investors. You're actually reinvesting your profits back and growing. So the bigger your assets is, your assets generate your revenue, and then you just go keep pulling that cycle, and before you know it, you're a multi-million-dollar business. But if you're not generating enough retained earnings, enough profits, that becomes retained earnings, that becomes your equity, then you find yourself always struggling because your asset is always dwindling. So on the next slide, we'll see how this plays out, and how, transactions add up to become, to build or reduce your assets. Now let us take a look at some examples of how the equation assets equals liabilities plus equity always holds true. I have some sample transactions here, and I'm going to show you how it plays out in the accounting equation. One, to start a business, a lot of business owners get cash from investors. So that is an asset source transaction. In other words, the source of the asset is the equity. So you see your assets, which is cash, goes up by $30,000, and equity also goes up by $30,000. We see that here. And then next, let's say they took a loan instead of an equity investment. So here we can see cash will go up by $10,000, but then they have a liability of $10,000. So now through the operations, they sold their product maybe for the year for $30,000. It costs $20,000 to make and service. So you see revenue here goes up by cash goes up by 10,000, which is the profits, 30,000 minus 20,000, and equity also goes up by 10,000. On the flip side, if we go down here, where we say sold product for 20 that cost 25,000 to make, we see there's a reduction in assets. Assets go down by 5,000, equity goes down by 5,000. Well, this is not what we want. So this is why in business you do want to sell at a profit, because when you sell at a loss, your assets also go down as a result. And remember, you're in a business to build assets, because your assets is what keeps generating income. Here, where we see what we pay the liability, we see cash go down by 10,000, which is an asset, and the liability also goes down by 10,000. And then when you make payments to investors for 5,000, we see cash goes down by 5,000, and equity also goes down by 5,000. So every time you use up the assets, you see its value goes down. And when we make income, we borrow money, or we have an investor invest in our business, we see our assets also go up. Well, it looks like this business did not really do that well during the year, if this was the year's transaction, because at the end of the year, they end up with 30,000, which is really what they started out with from the investor. So they really have not taken that money and used it very well to generate more assets, because at the end of the year, what you want to see is that your assets increasing as a result of your activities. So now let us take a look how the accounting equation actually transforms into financial statements. Because we got to remember, the main thing we're trying to go after is how to create and interpret financial statements. So we want to know how, okay, this accounting equation, we say it's very important, but how does that translate? First, I would like to talk about the income statement. Well, the income statement is the financial statement that matches revenues with your expenses. In other words, the income statement is not concerned about the dividends you pay, is not concerned about your liabilities. It just wants to know how much revenue did you make, how much expenses did you spend to make that revenue. and it tries to match it. So your net income, which is the difference between your revenue and expenses, can be properly accounted for. Or sometimes it's a net loss when you have more expenses than revenue. But when you're in business, you don't really want to have a loss. You really want to have an income. So you got to remember, income statement is only concerned with revenue and expenses. Do not confuse dividend payment for an expense, because a dividend is not an expense used to generate revenue. It's something that it's a return on an investment for the investors. So look at this transaction that we've looked at before. We see the only thing that's generated from operations, revenue, expenses, is this line and this line. So now we see we have revenue of 30,000 plus 20,000, 50,000. Expenses of 20,000 plus 25,000 is 45,000. So we have a net of 5,000. Or we can say here we have 10,000, 5,000, net of 5,000. Next, we'll see how that computes into an income statement. Here we see the transactions represented in an income statement. We see revenue of 50,000, expenses of 45,000, and we have a net income of 5,000. As you can see in the income statement, the only thing we represent here are not liabilities, are not assets, nothing else but your revenue and expenses. The difference is net income if there's a profit, and if it's a loss, it's a net loss. Once you create your income statement, the next thing you want to do is create your statement of changes in stockholders' equity. This financial statement explains the difference in transactions in equity transactions. Um, it's equivalent to what you would call the net worth. If this was an individual, like a personal, you have your assets. Maybe you have a house, and then you have you owe like 30. The house is worth $50,000. You owe $30,000, and then you only have $20,000 equity in the house. So if that's your only asset, liability, and equity, then your net worth will be $20,000. In the same way, a business has an equity. The equity investment is the owner's stake in the business. So they might have 50,000 assets. Well, 30,000 of that might be liability, and they only own like $20,000 of that. So it's kind of important to know what causes changes in the equity. So here we see from our previous transactions, the only thing that get carried over are the changes in common stock and changes in retained earnings. So remember, when we talk about equity, we're talking about changes in common stock and changes in retained earnings. We had a common stock, we had an investment of $30,000, so that increased by $30,000. Now, changes in retained earnings is caused by changes in net income and changes in dividends. We had income of $5,000, but we gave that away in dividends, so we see our net change in retained earnings was zero. So at the end of the day, we only have 30,000 equity, which was the investment we did in that business. We generate nothing from retained earnings. This is not generally a good way to operate a business, because when you operate a business, you want to see at least a positive here. You want to see net income less dividends become a positive. So like I said earlier, this business did not do very well. The next financial statement I'm going to talk about is the balance sheet statement. Now, this statement is really the accounting equation. Assets, right here, equals liabilities plus your equity. If you look at the previous discussion, we saw that the accounting equation was really this. Assets was 30,000 at the end, liabilities was zero, and our equity was 30,000. We're just presenting the accounting equation in a different format. So here we can see from our statement of changes in equity, we had 30,000 for ending common stock. That's what goes into the balance sheet statement. In the statement of changes in equity, so we had zero for retained earnings. That's what goes in here. We had 30,000 in cash. At the end of the day, assets must always equals liabilities plus equity. So these two transactions, the 30,000 and 30,000, which is assets, must always equals liabilities of 0 plus 30,000. If that does not hold true, then you have done something wrong. Next, we come to the statement of cash flow. Cash flow is so important because without cash, it doesn't matter how profitable you are, you can still go bankrupt. It is cash you use to pay your vendors. It is cash you use to keep your business going. So because of the importance of cash, we have a whole statement that tells us the sources and uses of cash. So before you start your statement of cash flow, the first thing you want to do is identify all your cash transactions. So the example I gave previously, all the transactions I gave for cash transactions, and then I listed them here. As we go on to future chapters, we'll see that it's not always the case. You could have transactions that don't involve cash, but when we start out, we see all our transactions are cash, so that makes it easy. So once we identify our cash transactions, we want to figure out what the sources are. Is it financing? Is it investing? Is it operation? Now, financing activities are inflows or outflows. So, like inflow for example, financing your business. So when you issue common stock or you finance, you take a loan, that's financing. You're financing your business. And then the outflows will be like when you pay dividends. That will be an outflow of a financing activity. And then like investing is when you use cash to buy investments, like for example, equipment, computer, land. Those are things that you use to generate more cash in your business. So the cash outflow for that is called investing. And then finally, we have the cash from operating, which is cash inflow from revenue or outflow from expenses. So we'll go through all these transactions and see where they belong before we even create a cash flow statement. So we acquire cash from investors. That's a financing. We acquired cash from creditors. That's another financing activity. We sold product for $30,000, cost $20,000 to make. That's operating. We paid liability. That's a financing outflow. We paid dividends to stockholders. That's another financing. And we sold product. That's another operating. So once we know the sources of cash, we've done the classification. Now we can create our statement of cash flow. So here, cash flow from operating is this 10,000 minus the 5,000 gives us 5,000. We have no cash flow from investing. We can see here there's nothing from investing. And then cash flow from financing is 30,000 plus 10,000 minus 10,000 minus 5,000 gives us 25,000. So we see our ending cash is 30,000, which is our total assets, because our only assets in this case was cash.